Have you ever looked at someone else's investment portfolio and thought, oh, I've just left it too late? Maybe you're 25 and wish you'd started at 18. Maybe you're 40 and wish you'd started at 25. Or maybe you're approaching retirement and thinking, is it even worth investing at all? The reality is that the practicalities of investing at different ages will look different, but the fundamentals will remain the same. So in this video, I want to walk you through what investing looks like at any stage and why it's almost never too late. Hi and welcome back to my channel. I'm Zoe and this is Words on Wealth. As a former wealth manager, I break down key investing terms and headlines to try and make you a more confident investor. Now, there's some key theory that we need to dig into before we dive into each and every age and what investing would look like at those different stages. I'll drop a link to my video now, which goes through some of the investing fundamentals, what I would choose in a portfolio and how I get started if I was starting today. But you'll see in there a whole playlist as well that has everything you need to know, hopefully, about investing. So one of the main theories around investing is that the longer time horizon you have, the more risk that you can afford to take. And a lot of that comes down to the concept of market cycles. So the market generally goes through ups and downs. That's normal, it's what we expect. Whilst we might not like the downs, they are there, and historically, those up and down cycles have played out around every 5 years. So with longer time horizons, I'm talking longer than 20, 30 years, those little chunks of 5 years can really stack up. And crucially, you've got the time to ride out multiple ups and downs before you need to start accessing those investments. Now, with a shorter time horizon, let's say 10 years, you've only potentially got 2 cycles of ups and downs. And what that means is that you've not got the luxury of time on your side. You can't afford a massive dip that drags down the value of your portfolio right at the point that you need to start accessing that money. Usually, with higher risk investments, what we see is higher levels of volatility and therefore higher levels of time horizons and risk appetites needed. But with that greater risk comes the greater potential for growth. So when we're looking at things like life cycling portfolios, which are funds that are created for people's lifetime, usually what happens is that they move from higher risk investments at the beginning of their career when they're younger through to lower risk investments when they're nearing the end of their career and retirement and they're a little bit older. But this is just one part of what goes on, because whilst the investing part is clear and logic and the theory behind that, there is, of course, also then those human parts, the aspects that impact us at each and every decade of our life, and also how they impact what we're doing. I'm talking things like psychology, whether we are consistently able to keep up with the investing, whether we're able to withstand some of the worry and the risk that comes with those different ages and stages, and whether we're able to still apply the logic that we've talked about, even in a nutshell just there, no matter what age and stage we're at. So I'm going to start today with teenagers, right at the beginning of the first little bits of earnings coming in, and probably the first time that things like investing, retirement, and those future financial planning concepts are being introduced. It's never too early in the same way that it's never too late. So if you're a teenager watching this, or you've got teenagers in your life, then crucially what you've got is time on your side. Because, as I've just mentioned, those key cycles of ups and downs, the concept behind actually the longer time horizon you've got, the more risk you can afford to take, you've got bags of it in your teens. And whilst you might not have loads of money because you're not yet starting your career or you're not yet fully on a high earning career trajectory yet, you have got the benefit of both that time, but also the ability, therefore, to just soak up knowledge. If you're in the UK, you might be using the likes of a junior ISA. If you're in the US, you might be looking at a custodial account. And across Europe and other countries as well, there are child-specific investing products that exist that allow you to have some of your own investments. A lot of this stage at being a teenager is about learning. It's about learning what an ETF and an index fund is. It's about seeing that play out in real time. It's working out how you see investments within a platform. It's working out how you set up a simple direct debit and put into place those habits and that consistency if you are starting to earn a little bit of a wage or a salary, and how that then plays out into your financial situation. You've got loads of time to potentially see some big ups and downs in the markets, so you'd probably err towards the greater side of risk. But really, it's just about soaking up all the knowledge that you can get and putting that into reality. Let's move into your 20s, where you've still got that time on your side and you're probably in your first job, beginnings of your careers, starting to earn your own money, but also with potentially quite a lot of constraints, not least of which nowadays in many countries. You'll probably have things like thinking about renting. You might have things like thinking about buying a property, depending on where you are on the cards. You might also have things like travel and other desires at this stage, working out who you are, what you want, and what you want to be doing, all of which can come with some tricky financial situations. So for me, the most important thing that you can build in your 20s is consistency. It's firstly about getting some level of emergency fund in place. It might not need to be huge because you might not yet have any big dependents or big financial outflows, but get something there as a buffer. Secondly, it's about getting any high interest rate debt under control. If you've come through with student loans that are particularly high interest and associated with banks, for example, that might be a key priority. Equally, if you found yourself in the position where you're taking out credit cards and other payday loans, then make sure that you really get them in check and try to avoid, wherever possible, the habit of spending outside of your means, aka spending more than you earn or spending more than what's coming in. And thirdly, it's about building some consistency into the investing. I think one of the biggest myths that I encounter and I see is that you need to have loads of money to start investing, or there'll be a perfect time at some later point in your life, when actually just starting even with small amounts is really, really changing to your overall financial picture, particularly in the future. So in your 20s, if you can do some of those basics and get even small amounts away into still relatively high risk investments at this stage, then that could really transform what you have in retirement and what you need to do further down the line as well. Zooming into your 30s, and I'll caveat by saying that I'm aware I'm being quite stereotypical, but we're looking at, of course, a more or less stereotypical journey here for people to take away and look at this as part of what they could do with their investments, rather than pigeonholing everyone into exactly the same life path. I appreciate it's not always quite like that. What we tend to see in your 30s is that there becomes more and more competing demands on money, whether it's mortgage, whether it's career progression, whether it's children, whether it's also things like saving for retirement and other periods out, such as mat leave if you're a woman, or indeed bringing up a family if you're both in a couple as well. Now, what this really means is that it's time to start to get a little bit more strategic. Hopefully, you've laid some groundwork in your 20s. If you haven't, don't panic. It's about putting that knowledge in place now and getting things moving, because it really is not too late. So if you're in your 30s, you might want to be looking at separating accounts. For example, you might have something set aside for retirement, and within that, you've got quite a long time horizon, so your investments might be quite high risk. You might have another pot that is for children, for example, for their future. It might be some long term in the future, but it might be slightly lower risk. You might then have another pot that's for slightly more immediate needs, be it for things like time out of your own career, be it for things like taking a pivot, be it for things like perhaps a property move, whatever that might look like. It's about getting strategic with what you've got, making sure that where appropriate, you're still pushing the risk by using higher risk equities, for example, things in emerging markets, not just tending towards the likes of bonds and lower risk funds. You still want your portfolio to be very diverse wherever possible. It's not necessarily about just diving straight into individual stocks, but rather keeping a view that is long-term, diverse in its nature, using things like funds, ETFs, but also, as I say, pushing that risk, because time in your 30s is still on your side. So don't be afraid to have a look at whatever it might be, as I say, things like traditionally emerging market, smaller cap stocks, and potentially some alternative assets in there as well, as you've got the time to hopefully get that portfolio to grow. We're now looking at the age of 40s, and this I find is where people tend to panic the most that they've left it too late. Newsflash, it still is not too late. In fact, you might still have at least 20 to 25 years until you retire. Just a really long time to get investments to grow, and you've still got the ability to take risk within that as well, because you've got that longer time horizon. But whilst the 40s decade can see lots of financial constraints, if you've had children, for example, they're often starting to grow up, becoming more expensive. But you might also have things like bigger mortgages. You might also have potentially things like ageing parents putting strain not necessarily on finances as you think of it. It might be if there's care costs associated, but it is just another mental burden that can also have an impact, a knock-on effect on things like your career and your earnings. So let's start to branch off. If you're in your 40s and you've been investing since your 20s, through your 30s, and now, what the main focus will be is about rebalancing. You've still got plenty of time to take risk, but it might look slightly different if you're at the latter part of your 40s than if you're at the early stage of your 30s. It's quite a broad span of ages there that I'm grouping into. So, if you are moving to the latter part of your 40s, for example, you might start to introduce more exposure to the likes of bonds that have slightly lower volatility levels. It might not be that you're going all out. Of course, you still want relatively high exposure to higher risk assets. I'm still talking the likes of emerging market equity, small cap equity, but you might just be reducing that and increasing your exposure to things like developed market equity. And that is stocks in more developed markets. And as well, you might be looking more at large cap rather than huge levels of exposure to small cap. Now, if you're just starting out, you've got a decision to make. How much risk can you stomach and can you take to try and make up some of the time that you may have missed by not investing in your 20s and 30s? I will reiterate, it is never too late, but you've just got a different decision to make. If you're somebody that does generally have a higher tolerance to risk, you might opt to push a little bit of growth in your portfolio for, say, 5 to 10 years, and then steadily drop down the risk as you move into your 50s and eventually 60s as well. If you're somebody that's like, no, I don't think I can do that, actually, that's just not for me, absolutely fine. The payoff that you might see is that either you have a lower pot level, that is, investments as and when you reach retirement, or you simply need to contribute more at this stage. And actually, for anybody in their 40s, upping contributions wherever possible and keeping them consistent is one of the main factors that we see in driving success in later points of retirement and having what it is that you want invested to be able to fund that lifestyle. So if you are somebody that is going for that higher risk approach, as I've mentioned already, you might be looking and leaning towards having a greater level of exposure to things like small cap stocks, to things like emerging market stocks, or to other alternative assets as well. You still want to have a diversified portfolio, but it might be a focus for 5 to 10 years. If you're somebody that's looking to just take it a little bit slower than that and not go all in, then you might reduce your overall exposure or indeed totally eliminate it. You might decide you don't want any emerging market assets because they're simply too volatile at this stage. That's absolutely fine. You can still see relatively strong levels of growth from developed market stocks. I'm talking the likes of the US, the UK, Europe, Australia, Japan, and so on and so forth. Alongside as well some exposure to bonds and potentially some other balances as well, such as gold and property. As we're moving into our 50s, things do start to shift because generally people are nearing the point where they're thinking about retirement. Might not be next year, but it certainly is closer on the horizon than it was when I started this video with teenagers, for example. So as we're moving into our 50s, we're more likely to be thinking about things like income and preservation rather than accumulation and growth. What that means in practicality is that firstly, you might be upping your exposure to the likes of bonds, which are seen as slightly lower risk, slightly less volatile, and also in that more preservation income generating class. It doesn't mean that you're going to totally remove all exposure to equities. In fact, that's never going to happen. But actually, what you might start to do is eliminate the exposure to very high risk equities, or indeed just drop it down. And you might start to increase your exposure to things like dividend yielding stocks, those that generate healthy and steady dividend. If you're in accumulation share classes, for example, in Europe, you might be shifting over to start to move towards income or distributing share classes within those equity-based funds so that you know you can eventually start to take an income from them as and when you'll need it. At this point as well, people often look to do things like maximise their pension contributions and strategise things like mortgage payoff dates or whatever else is going on within your financial picture. because they are still key to the overall point that you want to get to, which is hopefully living a lovely life at retirement when you're living off your investments. Okay, and into your 60s and beyond. One of the biggest myths that I think there is out there is that somehow you reach retirement and it's like ping, a microwave has gone off and you're going to take all of your money immediately out of your pension or other investments that you've saved up and it'll just sit there languishing in cash. That is not the case. In fact, a lot of theory around investing to be able to support you in later life at retirement is based on the idea that your investments remain invested. They generate a steady level of growth and income for you that allows you to take around 4% out of that investing pot each and every year without eroding away what's there. The reason for that is because none of us know how long we're going to live. Of course, would it be great? It would be interesting if we could have some sort of calculator to know when that point was going to be, but we just can't. So if we retire at 65, let's say, we don't know if we're going to live to 75, 85, 95 or 105. Many of us might hope for 105. Many of us might go, actually, I'd be quite happy to get to whatever age it is in a happy and healthy state. But we're going down a very moral and philosophical route there. Because crucially, you don't know how long you're going to live, and therefore trying to calculate how much you can take out each and every year on an unknown number is almost impossible. Hence the theory of growing your investment pot and withdrawing sustainably from it. So when it comes to your 60s, if you've been investing through your working career and through your lifetime, this really is about focusing on that preservation and income generation. I mentioned what you might start to shift towards in your 50s, and those priorities just increase in your 60s. You really will be looking to double down your exposure to bonds that generate an income, to stocks that generate an income, and to reduce the overall volatility and high risk exposure. Many may start to introduce some financial planning decisions as well, such as starting to withdraw from investments in advance so that there is some money held back in cash to avoid, for example, a big downturn in the stock market, meaning that they can't retire when they want to. This might involve introducing some other products as well, whether it is, for example, short-term government bonds or inflation-protected bonds, whether it's things like introducing other cash-based products and savings accounts. This is all part of the strategy that will start to take place as retirement and that leaving work and earning point becomes more of a reality. If you haven't started investing before the age of 60, I'll reiterate again, it still is not too late. The decisions that you make will just be different to somebody who is in their early 20s. Now, this one kind of branches off into multiple different avenues because the decisions that you make if you're starting investing in your 60s will very much depend on what it is that you want to get out of them. Are you investing for preservation purposes? Or are you investing to pass this money on to the next generation? Or are you investing to try and support your retirement at some stage? If it's the first and the second, you will know how long it is that you want that to go on for and what it could look like. But if in doubt, it's always worth having a quick look around at things like inheritance, the rules and the laws around it and how things get passed on, because things can become quite complex quite quickly. If you're starting investing to be able to support your own retirement in your 60s, this will mean that you'll simply be taking decisions that, as I say, within that portfolio makeup will be slightly different to somebody who's in their 20s. You'll probably be pushing a little bit of risk somewhere in there to be able to facilitate your lifestyle, but bearing in mind that actually big swings, lots of volatility within higher risk assets might not be appropriate for you now. And actually, the best thing you can do is just to get things moving within some more, for example, diversified developed world stocks alongside a healthy proportion of bonds or other balances in there as well. So whilst your portfolio might look different if you're starting investing at 20 to starting investing at 60, the fundamentals still look pretty much the same. You want to remain diversified wherever possible. Often people at any age and stage use the likes of ETFs and funds to facilitate this. Secondly, you want to remain consistent because time in the market is so much more important than timing the market. And what this can mean is that wherever you start, just try and keep up a healthy habit. Thirdly, you want to make sure that some of those more budgeting-based decisions, i.e. living within your means, setting aside small amounts to put towards your future, are really set in as soon as you can. I haven't gone too much into it on today's video, but they are some of the basics that are there no matter what age and stage you're at. And last but not least, try wherever possible to remain logical. Focus on that time in the market, try not to panic and withdraw, and keep those overall portfolio splits in mind as well when thinking about your risk tolerance, your age, and what it is that you want to achieve with your investing. And remember that often the simple portfolios outperform the more complicated ones in the long run. So don't make things too difficult for yourself. After all, sounds like we've all got enough going on in our lives, no matter what age we're at. Ultimately, all we've got is today. So don't spend time wasting and wishing that you'd done things yesterday that we just simply cannot change. Ultimately, starting sooner rather than later, aka today rather than tomorrow, is pretty much always better when it comes to that investing and that time horizon game. If you've enjoyed this video, do let me know in the comments. I'd love to hear from you. And if you're happy to share, let us know which age and stage you're at and where you're looking at your investing portfolio. And I'll see you in the next one.